Good morning, welcome. It's 11:30, there's still people coming in, but let me start already by welcoming you this morning to this presentation of this report from a task force on new Commission, new priorities, on basically priorities in the domain of finance. We at CEPS, together with two sister organizations, ECMI and ECRI, started a task force about a year ago to look forward, say what should be on the agenda for the next 5 years. With a group, a very multidisciplinary group, people from industry, people from academia, officials. We met over a period of 1 year to discuss many different issues, regulation, supervision, competitiveness in the financial sector. Then we discussed the draft report. We started to discuss the draft report in the month of June, finalized it over the summer. And here we are with the final report, for which we had as a chair Jesper Berg. We took an outsider, insider, to help us draft through the process, get us through the process, which was, I think, very, very welcome. Jesper is a former head of the Danish FSA, was also formerly on the board of directors of EBA, but before that worked in the ECB and also in the banking sector, in the Danske Bank, if I remember correctly. ECRI, yes, and a mortgage bank. So was very good at experience, and we had then 3 rapporteurs for the group, which is Judith, Apostolos, and myself. And of course, we had a wide group, as I said, of members of the task force, several of whom are here, whose kind of comments we took on board on this report, and which I think we very happily present today. Because what I miss sometimes in this town, we have seen that over the last months there have already been plenty of reports on what the Commission should be doing the next 5 years, but of course many of these reports are from interest groups. Of course always giving a specific focus, and what is sometimes missing is kind of the non-interest of the broader public interest perspective, which we want to give with this group. But also, it is not only the report of these 3 rapporteurs, Jesper as well, it's also the report of the larger group, which has given comments and extensive comments on the many different revisions which we've done over the kind of past months. Let's say we had 2 or 3 rounds of comments, let's say, and then anyway, only 10 days ago, we reached the final report, which we'll present today. So, as I said, it's the result of a broad consultation, a broad discussion among many different members from many different sectors of industry, but also from academia and from the public sector to discuss what should we be doing. And of course, there's a lot to be said. We have heard it already in broad reports and the many different reports which have been published on the subject at EU level as well. The Letter report, now recently the Draghi report, also what the Eurogroup has done, what the ECB has said. We now want to make our own contribution to this debate. And we're very happy we can present this today together with, so I will invite Jesper to the scene, who will present it briefly what our conclusions are of the report. Then we have John Bergen, who was, by the way, also present in the first meeting, and the first meeting which was in October last year, and will then, from his perspective, give comments on the report. There are still places over here, please. And then we will have comments from Eva Popcheva, but she's in Strasbourg. You can give us probably already also some view from Strasbourg, what is the first comments on the composition of the new Commission. But Eva was a former MEP, was amongst others rapporteur for the AML or the AMLA regulation, and also a shadow rapporteur for the Listing Act. And then Judith, who's sitting there, will also comment. Apostolos is also here, let's say, he can also comment. But of course, we're also here to get comments from you, questions from you at the end. So our plan is to have a debate of about 1 hour and a half. So we will start with Jesper, then we'll have John, you can stay a moment, and then you can come up, and then Eva, and then Judith, and then we'll of course have questions from all of you. So I pass the floor to
Thank you, Carol.
Jesper, let's say, and thank him already for the patience he got, let's say, to be with us in this journey. And I think it was very useful input, and also to have an input from a member state.
Yeah, so it was a great pleasure to be part of this, and thanks to everybody for all of their contributions. Thanks for Carol for inviting me to be part of this. Thanks to the Secretariat of Apostolos and Judith and others. Thanks to the people who participate in the discussions. Thanks to John and colleagues from the EU Commission for showing up and giving us really good input. I'll spend 5-6 minutes on a couple of topics. I'll start by taking you back to when I was the head of division in the ECB in the forming years, starting in 2000, and 4 years ahead in the monetary policy area. And every morning I walked from my apartment and I passed a conditorei close to the ECB headquarters. And in the windows of that conditorei, there was a picture of how Frankfurt looked just after the Second World War. It was basically rubbles, a little bit of the cathedral standing, and it was a reminder of why we are here as part of the EU in terms of establishing something where this will never ever happen again, and how we can move forward. So this is something which is very profound to me. The saying that, and also looking at where we are now, I'm a bit worried about the excessive pessimism on behalf of Europe. I think we have a good place in Europe. I think we have a continent which has a lot of history, a lot of differences, and we should build on the strength of some of these differences and how to do things. So I would caution against excessive pessimism. I would caution about that we should become like the US. I think we have a much better continent and we should aspire higher. And that does not mean that we should be the famous open air museum, just resting on our laurels and be a place of history. But we should use our history. We should use all the things which has been developed in Europe to make this an even better place. I want to focus on 3 things that being said. The first is something which I've myself been part of. I was a regulator and a supervisor, and I've contributed to writing many rules. And when I look back, I would probably say, like Draghi also said in his report, and like Macron said in his Sorbonne speech, that I think we need to reconsider the size of the rule book and the way we move ahead. And a few years ago, when I was head of the supervisor, I asked my staff to look into how many pages was in the single rule book, and I arrived at 15,000 plus. And since then, we've added the whole ESG, we've added DORA, we've added MiCA, we've added artificial intelligence, and many other things. So I'm sure we are well about 20,000 now, and tons of delegated acts. And I think all of those who've written these things have done so with good intentions. So I'm not trying to say that they did bad. I think it has been drafted by a lot of diligence, input from all the countries, but I think we need to look up and revisit the size of the single rule book and possibly move a little bit more towards something in principle rather than the details, because even though we write all the details, we will end up with people finding ways to circumvent it. So although principle-based supervision or regulation got a bad name during the financial crisis, I think we can also move too far in the other direction. I'm a great believer in common law and the fact that you should be capable of looking a judge or your grandmother in the eyes and say what you're doing is right. And I think that sort of shifts the attention towards supervision and the need to do good supervision. Let me make one specific point, and I know for John and others it would be a nightmare, and that is that fact that we've implemented the full Basel book for all banks, all MFIs in the euro area, whereas the US, Canada, Switzerland, China, Japan has taken a more proportional approach. And right now we have a lot of small institutions, banking institutions across Europe who are crucial to the functioning of the economy, who are crucial to small and medium-sized enterprises, and they're being killed. And we need to find a way in between. And I'm not suggesting lowering standards. I think, if anything, increasing the requirements to these institutions, but making life simpler. Let me give you one example, and that's the many forms of capital we have: CET1, AT1, Tier 2. I basically believe that the AT1 and the Tier 2, the main beneficiaries are the investment banks selling these things. And it's not the small institutions. So I would be ready to get rid of them, lift the requirements in terms of CET1, and make life simpler. And there are tons of other things where we could do that. So that would be my first input, and an input in the report. We need to revisit our strategy and figure out a way where we can do things simpler. My second is an old pet project of mine. I was involved in designing the resolution legislation in Denmark, and I'm a strong believer in that bankers should not land on the taxpayer. And I still think that we are in that situation. I'm fully aware of all the horrible stories that happens when you have to do bail-in for different kinds of investors. But I think that we are not following the spirit of the BRD. I know the new proposal of the CMDI is an attempt to get back to this. But I think a key requirement here is prompt corrective action. We need to shut down banks at an early stage where there's still value in the entity so that it can be taken over by somebody else, and that the losses are mostly imposed on equity holders and holders of subordinated debt. I think the problem is that most supervisors are scared stiff of taking that sort of action. They know that as long as they keep a bank alive, they keep their job. Whenever a bank fails, there's a public commission, an inquiry, and they lose their job. And on top of that, there are all the legal suits. I think in Spain was a good example. We had in Denmark in the early 90s that they're scared stiff of being subject of a suit. But I think we need to move to prompt corrective action, and I think another key thing is that the famous banking commission allowing state aid, we need to update that so that we get out of the state aid environment. So that was my second point. My third point is in relation to the CMU, which we also deal with extensively in the report. And my first message there is that we should not think that the banking system we have is not very valuable for the community. I think banks, in particular small and medium-sized enterprises, are absolutely key and absolutely key in getting the economy working. And I think we should applaud the way that banks work, and without saying that the only model is the US model. That being said, there are clearly things which banks have difficulties in doing, and there are tons of proposals in the CMU. I think our report says that we should focus on a few key things. And the key thing, I think, is to have a shift in the savings structure from bank savings to more institutionalized forms of savings. Pension and life is in terms of the forms of savings, is much more amenable to invest in capital markets instrument. Bank deposits are nominal and they're liquid. That doesn't square very well with having capital markets assets because capital markets assets are by nature, can they move up and down, and they are typically much more illiquid. Pension and life, particularly if you have defined contribution schemes, have the advantage that the liabilities are a share of the assets and they're illiquid. So they're much better in terms of driving capital markets. And that has been my belief for a long time. Coincidence have it that this semester I'm teaching a course at the University of Copenhagen in the financial systems for graduate students. I wanted to pass on some of my experience. And the textbook I got, when I looked into it, there was a chart showing it's Cambridge University textbook, Jack Schoenmarker is one of the authors. There's a chart showing institutional savings out the x-axis and capital market size out the y-axis. And the R squared is like 0.7, 0.8 or something like that, if you take European countries. So my priors were confirmed when I stood in front of my students. So that would be my third message. So in terms of focus, these three messages, we need to reconsider our strategy in terms of excess regulation. We need to get resolution working in banking. And for capital markets, we need institutional savings, and we need to move towards that. I know fully well that it is labor market and all the difficulties, but here I'm very confident, and if I may go back to before I knew John, I had a friend, a former boss of John's, I think, who was a director general here, Ole Buus Henriksen, who told me, and I think this was during the debt crisis, John Berrigan is doing this, so you can rest assured that it will be done well. So leave it to John to implement some of these things, and John is the next speaker. Thank you.
Thank you, Jesper, for this introduction. So we have sent the report also in advance to John, and can I invite John to come to the stage to comment, to give his comments, but also Judith, let's say, who is one of the rapporteurs, and then we have Eva Popcheva, who will also join us online to give her comments. As I said, John was involved in the first meeting of the group because I went to see him before that, just speaking about this problem which we had about principles-based versus rule-based, let's say this increasing amount of detail and rules on which John had very clear views at the time, so I'm very happy he could join us. But by the way, the report is also since about an hour ago posted on our website. You can download it, you can scroll through it. It is there, and we have about 10 recommendations. But John, thank you for joining us, and let us have some of your insights on how you see this process, as also Jesper already commented upon. Just put it on, yes.
Thanks a lot. You can hear?
Yeah.
Okay, very good. Thanks a lot, Carol, and thanks to Jesper for his report and his nice words, although the crisis didn't work out all that well in the end, but okay. An interesting day for me. I've not been able to speak too much in the last few weeks. I can even speak less now because I know who my new boss is, but I haven't spoken to her yet. So these will all be very personal reactions, and I may be back here in a month's time contradicting myself in Portuguese, but okay. First of all, I welcome the report. There's not a lot of disagreement, I think, as we can see in this report, which is a good thing in a sense. I mean, it might sound boring, but the fact that we have more and more consensus around the diagnosis is good. I hope we can get as much consensus around the cure, but it's good at least that we are converging on what is wrong. I agree with Jesper in one aspect that we shouldn't be overly pessimistic. I always joke that I'm paid to be optimistic, and so therefore I'm optimistic. But I think it is true that we should not, compare ourselves to other parts of the world in a sort of mechanical way. But we should use that to see to what extent we are reaching our own potential. And I think by any measure, we are not reaching our own potential in the area of finance. And I can tell you from personal experience, it's not for want of trying. We have tried, but it hasn't always worked out. And I've kind of reorganized my notes so I can follow Jesper's line of reasoning. I want to start first with this idea of the rule book and proportionality. Most of you know that even before Draghi, I was talking a little bit about the new normal. 15 years of crisis management seemed enough, and that we probably need to think about what was the normal pace of regulation going forward. We can justify the last 15 years. It's a long period, but we can still justify it on the basis of what went before. There was a huge gap revealed by the crisis, and we have now spent 15 years filling that gap. Whether we've done everything right, we will see, but I think you could justify the pace and the extent of regulation. Looking forward, we probably need to slow it a little bit. But there we have to be careful because we will offer a deal of stability, but then there's imperfection. So we offer stability, the market has to accept imperfection. It cannot be that we have stability, but people come and want this, and this. There will be imperfections, we will do it over time. But we can take our time then, and this is the 2028 review, to take our time to look at the framework and see what is working and what is not. But I remember 2008, and Jesper will remember this as well, we promised ourselves in 2008-9 never to get into the trap of the deregulation cycle again. This cycle where you have a crisis, you regulate like crazy, then someone starts worrying about growth, then you deregulate like crazy, setting yourself up for the next crisis where you start regulating again. It keeps people like me in a job, but it's not the way to run an economy. So I think there is certainly an openness to doing things differently, but not in a way that compromises on the fundamental objective. Because financial markets, as I'm telling all of my colleagues, can do a lot of things for your economy that are positive if the financial system is stable. If the system is unstable, it does an awful lot of bad things to your economy. So this is just the point I would make. We are open, but we need to be a little bit careful. We put some proportionality already in the system. We have this simple or this small non-complex banks, which we've asked the supervisors to build into their thinking. We will see how that goes. But again, this kind of tiering, we need to be careful. I mean, in other parts of the world, it hasn't worked out all that well. Not naming any names, but we know where it is. We do apply it to all banks. That's a complication, but that's mainly because tiering is complicated and creates its own risks, its own sort of cliff effects if you get the lines in the wrong place. So again, I think we'll be open to all of that, but we will need to do it carefully. I say this all without consulting my next boss, but I'm hoping she'll agree with me in principle anyway. Maybe then to move a little bit to CMDI and resolution. Yeah, I mean, I agree with you that the BRD is one of the most beautiful theoretical frameworks you can find, but, does it work? The CMDI proposal was an attempt to make it work better for banks that were too big to be liquidated, but too small to fit easily into the framework that we have in place now in the BRD. So we are trying to fill that mid-gap, which has always been the problem. We've always known, in the old days, we used to rescue big banks, bail them out. Now we bail them in. Small banks we leave to the judge. It has always been these ones in the middle that cause problems. And this CMDI was an attempt to address that, and still is, although the council position is not quite what we would like, and my current commissioner has made that rather clear. We can still work with the Parliament in trialogue, and let's see what we can get. But the point is well taken that the framework needs some work. Then on CMU, very quickly, I see a number of things here, all of which were reflected in what Jesper said. We need to boost retail demand. Without demand side, there's no market, and we need retail. We need to get retailers out of bank deposits into capital market products. For that, I think we will need a product. I think Christian Noyer is right. We need something. He said simple, I will add low cost. Simple, low-cost products that are accessible and available and interesting for the retailer. For that, we'll probably need pension reforms. For that, we'll probably need tax changes. You'll notice that neither of those last two things are in the competence of the Commission. So the member states will have to work on that, and the Eurogroup statement offers us that sort of framework where the Commission can help the member states do the heavy lifting, I think. We need to boost the efficiency of supply, and everybody talks about consolidation. Yes, particularly in the post-trading, it could be an improvement. But the thing to do here is, and this is a debate we've not really won in the Commission, is to get member states to focus on access to finance rather than location of financial markets. What's important is that you can access the market. And in fact, it's better that you can access a bigger market than you can access a smaller one. So rather than worrying about whether your local market is next to you, you should be thinking, can I access a better market even if it's somewhere else? That, I think, is a debate we're trying to have. We are currently visiting all the member states, trying to explain this, that trying to create your own little stock market, it's not the optimal strategy. Try to think about how you can access something local, something bigger. But we will see how the politics work on that. I mentioned securitization just because everybody talks about it. It's very important for banks. Probably not top of the list as a CMU product, but it is part of the CMU action plan. A lot of consensus there to work. We'll see how much consensus there is on what we're going to do, but at least we understand this. I always felt securitization in Europe got a bad press, and so I think we can hopefully do something there. Just a quick word on LTIF. We're not as negative on LTIF as your report, but that's just so you know. And then lastly, I want to say something on supervision, which is mentioned in your report. Has also been mentioned in the Draghi report. I mean, to be fair, Mario Draghi is very consistent. He has always said that a single supervisor is the most efficient way to deliver single supervision. Okay, he has not changed. The problem is that single supervisor is a very emotive thing and a very political thing. So I prefer to talk about single supervision and worry later about how we deliver it. But single supervision is essential for a single market. If you want to have a single market, the rules have to be the same and they have to be applied consistently, not without discretion, but consistently across the market. And that's where the single supervisor helps you, of course, because single supervisor can use discretion more consistently. But it's not, in my opinion, essential. But single supervision is. And therefore, improvements in supervisory arrangements must be part of what we're going to do. Politically very sensitive, but I think very necessary. So I'm not going to say much more than that. I wanted to touch on some of the big points. In general, we don't have a major problem with the report. It will be very useful input to what we're doing. And when I see my boss, I will be sort of telling her to read it. So there you go.
If I could add one additional question, John, thank you very much. On the whole complexity issue, which is also very much the focus of the report, let's say on the complexity of rulemaking, which also Jesper alluded upon. What can we do? Do you believe in something that we can try to have a more organized process? What is level 1, what is level 2, and to constrain somewhere this reference to level 2 and eventually level 3?
I mean, we've discussed this a few times in the past, and you've heard me discussing it in the past. Personally, I think level 1 is too detailed. And because level 1 is too detailed, level 2 gets even more complex, trying to square all the possible outcomes that level 1 creates, because it's too detailed. It's too almost deterministic. Now, can you get to a more principle-based level 1? Well, if you look at recent experience, it has been the other way, in fact, that the member states and the parliament have been more inclined to pull details up into level 1. So I will take it that I'm still amazed to see square roots in the CRR and the CRD. I mean, I know where I come from, primary law does not have square roots in it, okay? Not even in the annexes, by the way. But this has it in the body of the text. So it is too detailed, but this is a product of the way we work, 27 member states. Those member states want to see their specific interests guaranteed, and the way you guarantee them is in level 1. And I think unless we can move to a system where there's as much faith in the level 2 as a guarantor of your specific interests as in the level 1, it's going to be quite difficult. But from a purely intellectual point of view, absolutely, level 1 should be principle-based and level 2 should fill out the gaps. But whether we can get there, we shall see. I hope that's not too honest.
Thank you, very clear. We connect with Eva now, or Eva is, as I said, is a former member of the European Parliament, but is in Strasbourg as now head of unit in the EPRS, but was active in the previous legislature on some of these files and has views on level 2, level 3, etc. Eva, welcome, and I hope you heard the debate before.
I did, Karel. Thank you. Thank you very much. Do you hear me well?
Yes.
Okay, excellent. Well, thank you very much again for the invitation, and sorry that I cannot be there with you in Brussels. And first of all, also congratulations on the report, which I think it's probably the most comprehensive analysis out there on the question. And I just want you to share with you a couple of general remarks maybe, and maybe a little bit from my experience as a rapporteur and shadow rapporteur on the Listing Act and also on AMLA and the AMLD. That you also mentioned in the report. Maybe in general terms, and coming from the buzzword these days, which is competitiveness, and actually we will have Mario Draghi presenting his report in a couple of hours here in the plenary in Strasbourg. So obviously one thing that is common, I would say, in the competitiveness report by Draghi, but also in Enrico Letta's report, is precisely the question of scale, isn't it? And also one of the solutions that is kind of presented in both reports, which is to be maybe less restrictive in our competition policy and allow maybe to a certain extent the fusion of businesses so that they can really compete on the global context. And my point there is that financing goes hand in hand with this. So of course, if you want a little bit more consolidation cross-border of businesses, then of course this has to go hand in hand with more cross-border financing. And there, if we look, of course, at the banking sector, and there maybe I disagree a little with the report. You do need cross-border investment kind of activities by the banks. But if you look at our banks actually, and which are the cross-border investment banks in Europe, basically, I think among the 10 cross-border investment banks in Europe, just one is European, is the Deutsche Bank. The rest actually are US banks. So my point there actually is that we might have to look into some kind of flexibilization, because obviously after the financial crisis, we have tightened up a lot the possibilities of our banks to do this, to have investment portfolios. So, and one other point I think is also consolidation, how we achieve this. And I have the feeling, and this is also talking to different actors in the sector, of course, from the European level, it's very much wished for that this consolidation of banks takes place cross-border. But there is no recognition for the fact that sometimes in order to be able to consolidate cross-border, you would first need to consolidate nationally. And then, of course, governments get very scared about this. And we can see it actually just recently in the member state that I know best, in Spain. So this is maybe the first point on the banks. And then in terms of capital markets, when we talk about scale, I think you say in the report that the problem is not so much the fragmentation of the capital markets, but more the consolidation that we need is more in the post-trading. I'm not sure I completely agree with that statement, because I think it is a problem, because basically, and I think also the Director General pointed to this just now, we need, of course, more liquidity, a broad investor base, which we would have if we had less fragmented capital markets. And also another point that is very much, I think, sometimes ignored in terms of our objective, which is, of course, to invest more in innovation, etc., is that listing of companies also professionalizes them a lot. If you talk to companies, to the very few companies that have listed in the last years in the European Union as new companies, they will tell you that this really also helps digitalizing their processes and investing into innovation. And there I wanted to say something about the elephant in the room, and the Director General already pointed a bit towards it. And you also mentioned it a bit in the report. Obviously, in order to have more investment and to have more retail investment, I think there are two things that we have to tackle, and this is fiscal policy and the pension systems. But what I don't agree with the Director General with, and I've heard this from the Commission several times, is that the Commission has nothing to do with it. I mean, when we talk about fiscal policy, we can see how actually there is a tendency of a lot of governments in the member states to now tax profits more and more, instead of actually creating fiscal incentives for companies and for citizens so that they invest their profits and their savings into the industry. And also on the other side, the pension system. And I completely agree with this conclusion in the report that, of course, this is the one potential that we have to tap. And there we have in a lot of member states unsustainable pension systems. And what I cannot really agree with is that the Commission on the one side, let's say with the Next Generation EU, where the member states, several of them have committed to a certain pension reforms, is waving through certain pension reforms without really kind of also putting on the table that best practice from other member states, which is to work more with pension funds, which on the other side, is a win-win, because then we would have also more capital for the capital markets. And I'm not sure that the Commission has no role there to play at all, because we have the fiscal coordination, we have also the new fiscal rules. The member states now in September the governments will have to present their fiscal plans, medium-term fiscal plans. Well, they have to say also how, for example, their pension system weigh on their debt and deficit. And this is also, I think, exactly the moment for the European Commission to, also to make to member states, let me put this very diplomatically on the table, also this possibility or even need to reform their pension systems. And two very brief points. Sorry, my light is out. Do you still see me somehow? Okay. Also two small points on supervision. From my experience as rapporteur on AMLA, what was one of our primary objectives, I think, and I think this would be good also to have in all supervision. I understand why in the report you kind of criticize also supervision in terms of adding kind of more complexity. Our objective, for example, with AMLA was also to harmonize reporting formats, reporting obligations, to the benefit of financial entities that now have to deal with 27 different supervisors when we talk about money laundering. So I think this is definitely one thing that is very appreciated when we have different supervision bodies at EU level. And another thing that I wanted to share with you, a last one, also a bit of about the probably most important thing in when we're talking about the CMU, and this is the lack of political will. I know that now everybody is kind of gathering behind the Draghi report. You know, in the parliament there is even the talk about a possible Draghi coalition or Draghi majority. But to be very honest, when you are negotiating on certain very specific things that could bring forward the capital markets union, so basically governments come up with all kinds of reasons not to advance in certain things. One example in the Listing Act, for example, was the multiple vote shares. There was a very good proposal by the Commission, and I wanted to extend it, or not only me, but also with the rapporteur and the others here in the Parliament. We wanted to extend it to all markets, not only to SME growth markets, because we saw really the big potential there, precisely to have more listings by startups and family companies who often fear actually that they would have less of obviously of ownership once they list. And on the other side, of course, there is a big interest on the side of the investors to keep this knowledge at the startups and the family businesses. So the multiple vote shares actually is a very good concept for this. I can tell you that it was impossible to extend it, and we were given all kinds of reasons by different governments. In the north, they didn't want it because they thought they have it more developed than what we were proposing on the EU side. Others said, no, we are going to do it ourselves in 6 months, and all kinds of different reasons. So my point here is that I think if we want to keep this momentum for the CMU, really actually where the grant words are, we need more real actions also on the side of the member states. So that's for now on my side. Thank you very much, Karel.
Thank you, Eva. You stay with us. You will hear the debate if there are questions. Okay, very good. So I move to Judith. Judith, who's with CEPS, but also with Elcano, and before was head of cabinet of the Deputy Prime Minister in Spain. Judith.
Thank you so much. It's working well. It's been such a pleasure to work under the chairmanship of Jesper and to work together with you, Apostolos and Karel. So I think that, of course, I was a rapporteur, so I can only speak very well about our report, but I hope that you find it useful. So to be honest, I'm a bit concerned about how discussions are moving in the EU, because now the attention is shifting from the banking union to the capital markets union. Of course, this doesn't mean that I don't think that capital markets are important. They are. But if you look into our report, you'll see, and I know that you already know, that the EU is a bank-centric financial system. And assets-wise, the EU banking sector, the assets of the EU banking sector represent 250% of GDP, vis-a-vis 85% in the US. But if we look at market valuations, the story is completely different. So I think that we should really care about our banking sector and not simply say, okay, we're not making progress on EDs. The common backstop to the Single Resolution Fund has not been ratified by one member state. It's impossible to have a liquidity provision mechanism in resolution. So now let's simply discuss about something else. I don't think that's the way to do things. So I do agree very much with many of the things that have been said. So we need to preserve the competitiveness of our internationally active banks. And this, to some extent, means not making the life complex from a regulatory point of view. Now, if you look at all the vertical regulation banks need to comply with, but also from a horizontal perspective, like the AI Act, ESG. So that's a very difficult landscape. But this is not only the fault of the European Commission, I must say, who puts on the table legislative proposals. It's also the fault of co-legislators who, as Mr. Berrigan was saying, create very complex level 1 text, which then turn into even more complex level 2 text. But it's also the fault of member states. I mean, gold plating is a daily practice. So I think that this is common responsibility that we need to really tackle. And I couldn't agree more with Jesper when he said that we should also care about smaller banks, applying the principle of proportionality, not applying Basel principles per se to every sort of small bank in the EU. And this does not mean that we're going to have a less safe banking system. It can be strict, those can be strict rules, but simpler rules. I mean, I couldn't agree more with what you said on the CMDI. I think that the EU Council position is a step in the wrong direction. Personally, as Jesper said, I would expect to see that the banking communication of 2013 is brought in line with BRRD. And also, I would expect to see a legislative proposal on the harmonization of liquidation procedures at national level. I think that that would be very, very helpful. So I think that still there's a lot of work to be done when it comes to the banking sector without the need to fall into the fruitless political discussions of EDs. Of course, I'm totally in favor of EDs. But it's true that all the technical work has already been done. So it's for political masters to someday decide to go ahead with that. When it comes to the capital markets, building on what Eva was saying, I think that we have a problem of lack of development and fragmentation. But what is more worrying right now? I would say that lack of development. So it makes sense to tackle lack of development, at the same time also tackle fragmentation, and from our perspective that should start with the consolidation of post-trading infrastructures. And before closing, I think that we cannot solve everything with financial regulation and with making things simpler. And there is a very there is very nice data. I mean, not nice, because what the message that this conveys is not nice, but I think that it's pretty illustrative. And it is that in 2012, EU UCITS funds invested 15% of their assets in US assets. In 2023, it's 45%. So this is not only related to financial regulation, to a bad regulatory environment. This is related to the whole competitiveness of the EU. So that's why this debate goes, I mean, it's a multi-headed monster. This is only one of the heads, but all the others should also be tackled. Thank you.
Thanks, Judith. Is there any comments, immediate comment from the panel, from John or from Jesper on what's been said by the commentators? John?
Maybe
and then we open it up, of course, to questions.
Maybe just to clarify one point to Eva, that I'm not suggesting the Commission will do nothing in the area of pensions or taxation. We will certainly try to identify what works and where it works and how it works. And you have examples around Europe of where capital markets are relatively developed. Sweden is the one we normally refer to, but there are others. And there you find that it's about three things. It's about high levels of financial literacy, private pension provision, and tax incentives. These are the sort of things. So we will do this. What I'm saying is we do not have legislative competence in these fields. And in fact, it would make no sense to take legislative competence in because, for example, in tax incentives, the structure of taxation in each member state is different. So you have to leave it for the member state to work out how it wants to incentivize particular behavior. So if we were to give it a European level capital gains tax relief, well, a lot of member states don't have capital gains tax on capital market products, so this will give no relief. So I think we will have to, what I'm saying is we will still work, but work differently. And that it's not all about legislation. It's now about policy. And I think if I may say, you know, financial services is primarily a legislative DG, but we will also have to do policy now and work out what works, what is useful for legislation, and where legislation is less useful, and where the member states need perhaps to legislate at their level and not at EU level. But I'm not suggesting we're going to sit back and just watch it all go by. Yeah?
Thank you. Jesper?
Oh, I agree with John in terms of the approach he's suggesting. And I think it should work out because when you look at sort of both the needs for capital development, you need to look at the needs for fiscal policy action, and you need on sustainability in many countries of the pension promises made. I think this is the thing which can square all those three areas and need to be done at some stage. So that was my first point. My second point is also is more on sort of encouragement in relation to startups and venture capital. I graduated in economics in 1984, 40 years ago. Horrible thought. When I graduated, most of us went into ministries, central banks, and maybe large organizations and banks and other financial institutions. After I retired, I've been involved in a couple of startups. And when I go around in the city of Copenhagen, I'm sure it's the same in most other cities in Europe, I have discovered an enormous amount of startup activity among youngsters and people even sort of in the Middle Ages. And you walk around in these office buildings with glass walls and post-it notes all over. And you get actually very encouraged. There's a total shift from us being corporate bureaucrats or civil service bureaucrats to a lot of people who are willing to try out their dreams in order for these things to work. And I'm actually also positively surprised in terms of when I see the possibilities to get some finance. All won't get finance, but there's something going on out there which we should recognize and which promises well for the future and obviously needs support, but where dreams are being pursued in relation to startups, which I think will do this continent well.
So I open it up to questions. There will certainly be plenty. So who wants to kick it off? Please try to introduce yourself and be brief and to the point. Yes, we started with Josina, and then I see Gottfried and Rebecca.
Thank you very much, Carlos.
There is a microphone, yes.
Thank you. This is because I'm wearing orange, so you picked me out quickly. Thank you. I want to thank the panelists because they've each given us nuggets. And if you put them all together, it makes an interesting picture. So Jesper, you referred back to your view of photographs of post-war Frankfurt in the Konditorei and the ambition of never again what we saw. And that put me in mind of the coal and steel community. How ambitious was that, putting the essential industries of France and Germany together after a Second World War? That puts something in our mind, right, about ambition. And then, John, you were speaking about single supervision rather than single supervisors. How important is that? That was crucial, what you said. We should talk to the member states and get over these national angst that there is, right? And you can achieve it through using different words, because single supervisor is like a frightening concept. Single supervision is different. And then I think, Eva, on your mentioning on the listing and how important it was to push up, companies need to professionalize, absolutely. because it's also very difficult for SMEs that are not listed to see that whole sustainability issue in front of them and not get help. So, we need to bridge these gaps. And then I think you reminded us very well and wisely about the banking sector. We need to face reality. Europe is still essentially banking. But how can we link banks and asset managers, pensions and life? How can we link them together? So, sorry, it was more of a comment to stimulate debate than anything else. Thank you.
Okay, there's 2 questions here, and there are more in the room. Yes. Gottfried, and then Rebecca, and then we take a second round.
Gottfried de Wits. When I read the Draghi report quickly, this is 1999 again, right? There's actually the major problem is the member states. Now, Sean, you know this level 1 is too detailed, it's too much, everybody wants everything in it. So is there a way to change the willing member states to go forward instead of ours, the majority, everybody has to agree? That should make it much simpler, no? Maybe some don't like it. It's happening in migration, in other areas. Otherwise, we're going to be talking in 25 years. I won't be here anymore in 25 years anyway. But, we're going to continue to say member state, member state, member state. You have to break sometimes, some way, this level 1, which is too detailed, and it's going to be a nightmare the next 25 years if you don't change this.
Rebecca? Comments so far than questions, so we can go on.
Thanks. Rebecca Christie, I do have a question, which is, I would love to hear more about what you think about retail savings, the balance between institutional investing and retail investing. Because Jesper, you were talking about getting more money into the institutional sector, but then the pension funds are the ones that take all the risk, and the returns don't necessarily make it through to retail, depending on how people do their guarantees, how people if they sell an insurance product. It's not, from the retail perspective, they're not getting the higher returns. I see how from the economy it would be very efficient, as Draghi said, to get all that pension and institutional investor big deal money into the economy, but not necessarily how that goes to help the retailers. And Sean, you were talking about retail and a product specifically, which seems to really hope to get retail investors benefiting from those capital markets returns. So I'd like to hear your thoughts on the institutional power. I mean, there's so many questions about, do you give these asset management firms even more power over the economy? Do they have the right supervision? You give them this huge, even bigger intermediation role. Thanks.
Agreed. So a question there, and then we can return back to the panel.
Thank you. I'm Peter Teffer. I'm a journalist from the Netherlands for Follow the Money, so a question indeed. For Mr. Bergen, because I didn't hear anything about the mortgage market. I'm from the Netherlands. It never occurred to me that I could actually get a mortgage in another EU member state. But then I found out that there's a mortgage credit directive. In 2021, it was reviewed, and the conclusion was that it didn't really help create a single mortgage market. I haven't seen any policy initiatives since then. So my question is, has the Commission given up on creating a single mortgage market, or are you planning to do something? Thank you.
Yeah, 2 certainly very good questions and a comment or 2 comments. To return back to the panel, yeah, probably in the same order, Jesper, John, and then we see...
on retail investor participation and how to do it, I'm an economist by training, and as such, you have this belief that markets work, and you shouldn't be too restrictive. But I've also seen too much of asymmetric information, to use another economic concept. So I'm scared, and I tend to be paternalistic, and my profession has increasingly turned in that direction. Every year I go to the American Economic Association's annual meeting. It's the first weekend of January. It's the cheapest hotel weekend you can get. That's why economists have the annual meeting there. It's never in Las Vegas, because hotel owners in Las Vegas know that economists do not gamble because they know the odds. And it's a little bit sort of the same attitude I have in relation to a lot of retail investor participation in financial market. I'm dead scared that the information asymmetries are such that the retail investor will be cheated, and we will end up with scandals, and supervisors and officials will be hammered. So therefore, I'm very much in favor of retail investor participation through usage or through pension funds. And my own pension funds in Denmark, most of them are labor market pension funds owned by or managed by the employers and the employees, and with quite low cost ratios. So the benefits of investing in equities, alternatives, and all those sort of things actually accrue to the coming pensioners. I think, as we point out in the report, that there's clearly work to do, and I know John and colleagues have tried it, and in relation to usage and the cost of usage and the move towards more passive products and getting the economics of scale where the US is better than we are, and that's a long haul. But I'm not that married to the concept of retail investors going into individual shares. I think I've seen too much of crookery out there and people being misled. So there, despite my upbringing as an economist and a free marketeer, I tend to be paternalistic, and so do many of the biggest spirits in economics, John Campbell and at Harvard and others, when it comes to retail investor participation. In relation to the question on mortgages, if I may chip in, because as John knows, that's something which is
the subject very
dear
well.
to the Danes' heart. I think here we face the issue that a lot of the non-financial legislation is really very different and depends on very deep choices made by populations. In my own country, in Denmark, in Holland, it's the same. You can do a foreclosure in 6 months. In Denmark, you can do a foreclosure in 6 months because the local community has a rehousing obligation. In Poland, when my former employee Nykredit started lending out, they discovered that you couldn't do foreclosures between October and March because it was too cold to throw people on the street. So there are tons of idiosyncrasies in relation to social legislation in terms of local communities, which probably presents an insurmountable obstacle for the Commission to tackle, and maybe we end up also with the tail wagging the dog if we try to pursue these things. I think we need to find more the easy wins than the more difficult wins when it comes to these things. And I think although I would wish there was a common market in mortgages, I think it's really a tricky proposition and a tricky task because it's so dependent on so much other legislation, taxation, social legislation, property rights legislation, insolvencies, that it becomes really difficult.
Turn to John.
Right. Back to 99. I kind of started out in 99. I mean, it's not quite 99, I think. And there are 3 ways in which it's different, I think. And this, I have to come back on this, not be too pessimistic. I think the context is very different now. We have spent the last 20, 30 years telling member states that having a capital market is a nice to have. You have a very good banking system, and it would be nice to have a diversified system because this is beneficial to you in terms of resource allocation and risk sharing and all the wonky things that economists like us like to talk about. But it didn't really capture the imagination of the politician. The costs of doing it were still, I think, higher than the benefits that we could sell. The context now is a little bit gloomier, to be honest. I agree we should not be fatalistic, but there is reason to be pessimistic in the sense that if we don't change, the path is not looking so good. So I think there is now a different narrative around financial services reform in general and capital markets in particular. We need to do this now rather than it would be nice to do it. If we don't do it, we're going to miss out on the innovation wave. We've missed out on the technology wave. Now we'll miss out on the next wave if we don't change the way we finance, because banks are very useful for many things, but they're not so useful for financing innovation, that kind of high risk, high failure rate. We don't let them do it. We charge them for those kinds of things. So that is one way it's different. Secondly, I think the crisis has, which is on the, so in a way, it's a negative thing, but it's positive in terms of getting things done. The level of trust, of course, is much lower today than it was in 99, and that's because of the crisis. I mean, we all talk about the financial damage done by the crisis, the economic damage done by the crisis, but the fundamental problem with the crisis was that it basically broke trust among member states. And therefore, we've been trying to rebuild that using banking union infrastructure, etc. That's all good, but it takes time to rebuild that, and it's still not there, I think. And the third thing I think is the narrative has changed in a negative way on integration itself. When I started in this business, I'm sure Jesper as well, we used to spend our time describing the benefits of integration, particularly for less developed economies where there are non-linear effects. We always had this, it's much better if you're small and underdeveloped to be integrated than if you're big. The benefits are proportionately much greater. Today, the conversation is always about the potential costs of something going wrong, the potential cost of the tail risk event. No one talks anymore about the benefits of the 99% scenarios. So we need to kind of work on all of these three things. We need to make the member states understand that there really is a need to have issue here. Two, they may not trust each other, but they're going to have to try because they need to do things together. Trying to solve this problem separately is not going to work. Having 27 stock markets, 27 CSDs, 27 CCPs is not going to work. None of them is going to be able to get the scale to compete globally. And the US, people worry about sanctions on the US dollar because trade flows are being affected. But the power of the dollar is now in financial flows. It's not in trade flows anymore. The US is sucking in capital from all over the world, not just Europe, all over the world. But we have the size to kind of respond if we want to. And then we need to get this narrative going again. People like me have to start talking again about the benefits of having cross-border banking and having cross-border markets. My own country is a good example of how it works and how it can go wrong. But it can work if you get it, if you do it correctly. On the retail investment, Rebecca, look, we want to do this through, we need to get retail into the market because for two reasons. Not to create a capital market. I cannot convince anyone to have a pension reform to create a capital market. That's not the objective. The objective of pension reform is, as somebody was mentioning earlier, it's about sustainability, social and fiscal. But the capital market can be part of the solution. And probably the safest way to bring them in is through an intermediary, and a pension fund seems like a reasonable intermediary. But you have to be careful. As Jesper said, these are gateways, and the people in charge of the gateways can be good, or they can be, they can be seeking rents, and we have to be careful how they do it. But without bringing them in, the market's not going to work. And by the way, the banks are pretty powerful in Europe now at the moment, so it's not that you're introducing some new concept in here. And on the mortgage market, a general point. Regulation facilitates activity. It does not make people do things. So the Mortgage Credit Directive allows banks to go cross-border if they want. They don't want. And they don't want, I think, for all the reasons that Jesper has said, that things are just too different in non-financial areas. And that makes the due diligence around that just too heavy. And so in the end, they don't do it, or they establish a local subsidiary and they do it through that way. But the actual idea that you can, if you're in Ireland, tap into a lower interest rate in another country, and therefore we would end up with all the same rate. We're a long way from this because of all of these differences that Jesper said. Thanks.
Judith or Eva, any additions? Judith?
Yeah. So thank you. Building on this point of credit union, so we talk very much about the banking union, but the truth is that we are very, very far from a credit union. And this is one of the reasons why we say that fragmentation is not such an issue in capital markets. So if you look at the fragmentation in the banking sector compared to financial markets, you see how fragmented the banking sector is, as we are saying now, from the asset perspective, but even from the liability perspective. I mean, I'm Spanish. I have my deposits with Spanish bank. Maybe some of you have deposits with a bank from another EU member state, but that's not usually the case. And I want to bring to the table an issue that we mentioned in the report, and it is the importance of getting new regulations right when it comes to credit practices. And I'm thinking about FIDA, I'm thinking about the AI Act, and I'm thinking about how credit reference agencies are now suffering, for instance, from the impact or potential impact from the court ruling on the Shufa case. So let's see what ramifications this court ruling has, but let's try not to make the life of credit reference agencies more difficult. Let's try to have a reasonable interpretation or development of the AI Act when it comes to level 2, not to make credit scoring, credit worthiness assessment even more difficult. And let's try to find a good balance when it comes to FIDA. Because in this regard, I think that we need to be careful with allowing consumers to share the data that they simply want. Because obviously, if I'm a consumer and I want a loan, I'm only going to share positive data. But this is not good from a financial stability perspective. It's not good from a consumer protection perspective. So I think that we need to find the right balance for financial institutions to still have access to the data that are relevant to make a decision on granting a loan. Otherwise, open finance will not work. Thank you.
Yeah, maybe one point, Carol, on my side. On the question of of course all the balancing out of protection of the interests of and rights of investors and going into more retail investment. I mean, look, I agree, but I think we shouldn't also, like we should treat people as adults. And I heard that argument whenever it was comfortable, also against the multiple vote chairs. That's concept also that it's very clearly, indicated for those who are investing of what kind of structure this is. With this, I just want to say, I mean, we take a lot of decisions daily, and it's important, of course, to make them in an informed way. But I don't think the solution to this is to, kind of play with an unexisting security. Because, of course, if you don't tell people that actually their pensions are unsecure, because actually there is in Spain, we say the ucha, how do you say, Judith, in English? It's like, I mean, there is no, people in Spain think that, they pay pensions now and then it's going into some kind of savings and then they're, out of this, they're going to get their pension. And of course, they are not aware that they're paying the pensions of the people right now. So I think we have to inform people, and we have to be very clear about the risk, basically, of the unsustainability of pension system, but not also the risks in that sense, but also about the intergenerational balance and fairness. What is happening with pension systems right now across Europe, and we have the aging reports by the European Commission that are very interesting and that feed into the fiscal coordination framework, is very clear that everything is on the shoulders of the workers now and the future workers. So I think this is something that we have to just tell people, and then of course the protection of the investor as such is going to happen because people are going to be informed about the risks, but also about the unsustainability of the system as we have it now. And what I meant before in terms of the role of the Commission, and there I agree, of course, with John, is on the competence of the Commission. But I think that the Commission has a lot of instruments, and maybe it has to work more as one. What I don't think is very understandable is that, let's say, one pillar is acting in one way when we talk about fiscal coordination, and then is acting in another way when we are talking about, for example, disbursing the funds, the Next Generation EU funds. I think there is maybe some more room for improvement and for more coordination, and to be, let's say, more effective on like presenting the member states with certain choices that are probably better in terms of fiscal coordination. Thanks.
I look around for a further set of questions. I have Tanguy here, Rosa. Who else do I know in this room? Almost everybody. I'll start with Tanguy. Yes, and we have 4 or 5 questions. Donald.
Thank you. Good morning.
Yes.
Good morning, everyone. So the first is to
also Rosa had a question there. Take a question there and another one here, Donald. Yeah. It's not on.
Thank you very much. Любовь Pronina from Bloomberg News. I also have a question for John and also a question relating to the simple...
Where are you from?
Bloomberg News.
Yeah, okay.
I also have a question about low cost and simple products. What do you have in mind? What kind of products? And also, where do you view the retail strategy going from now that we also have the commissioner from today and the new parliament? Thank you.
Then a final question here, and then we go back to, mostly John, but then probably some others as well.
Thank you very much, Donald Ricketts. I share Sean's optimism in the sense that I think the conversation's changed dramatically. I don't think we'd have been 5 years ago even allowed to talk about the P word. I know we were talking about the PEP, but we weren't talking about the P word in such a holistic manner. It was off limits. So something's changed there. But I suppose two related questions. One is, you made a really astute insight, Sean, a number of weeks ago about the difference between acute and non-acute crises, and Europe tends to act in the acute phase and struggle with the non-acute phase. So question on this is, beyond the nudging and the moving from legislation to policy work, how you think, what will be tipping points to meaningful change here? The other reason why I can have optimism is the point you've made that actually Europe has great disciplines when it comes to saving. We just don't allocate it in the right place. So if we want that to be allocated in a more useful place societally, we've got to create the right incentives. And I think just a thought to throw in to hear your response on it is that it's not just, and of course tax incentives play a crucial role, but if we want people to do something, we want it to be easy. And you've heard from a number of reactions in the room that there's great concern about exposing citizens to the wilds of pensions, private provided pension systems. And that can obviously lead to reams and reams, and we have it in PET where you have a sort of a double layered protection mechanism which nobody ever wants to use because it makes the product excessively expensive and sort of unattainable. So can we think of a way of reconciling this by integrating, as we have in that product design, investor protection into product design? You have life cycling, for example, for target date products. which mean in a default phase, you can have comfort that your punter is cared for by that default design. And in that state, a product becomes a lot more accessible and much less expensive, and you can start to build scale.
Okay, we go back to the panel, mostly first probably to John. A lot on retail investment and on, say, affordable products, but also something on consolidation in the stock exchanges.
Okay, just to go through that, yes, there is a risk that if you talk about single supervisors, we get very bogged down in a conversation. So I think it's better to speak about single supervision and think about ways in which you might deliver that. I mean, single supervisor is one of the ways, but it's not the only way. And I think that's the, so I think it's important, but it's not, as you said, the only deliverable. I don't want to relitigate the retail investment strategy. People have heard me speak many times about that. We have an investment strategy on the table. It's currently heading towards trialogue. It's as always never improves in co-legislation. The Commission's proposal is always better by definition, but this one hasn't improved either. But I think it's missing, I mean, the basic point, and here I very much agree with Eva. I think we have to understand two things. I have never liked this idea that European citizens are not risk takers. We are culturally not risk takers. I've told this story 100 times about Ireland. It's complete nonsense. We respond like everybody else to incentives and disincentives. And if you make it unattractive to invest in capital markets, either by not making it attractive through taxation, or as Eva said, telling people it's going to be all right because your public pension is fine, so this is the other way, they're not going to go in. But I spoke recently to a bank, a challenger bank, who had launched a product around money market funds, and in 1 month had a couple of 100,000 people applying. I asked why. He said two things. One, we told them about it, and two, we made it easy to get at it. I would add three, it was a money market fund and very low cost. I checked my insurance products. I have an insurance product last night. They sent me my 23 results. I paid 5% fees. 4.8. Sorry, 4.8%. It was a good year for the insurance company as well. So there's an issue here. This is also part of the incentivization or not to enter the market. Because even if I make, and I didn't, but let's say I made 10 and I'm giving away 4. That is a disincentive as well. So this is what I mean. I'm not saying that we have to invent products, because we don't. We have products around. We have simple products around. We have UCITS, we have ETFs, we have all sorts of things. We don't need to invent new things. We just need to make sure that they're accessible to people, easily accessible. But I won't relitigate the retail investment strategy. I've just done so, but I won't. You're right about the 3 exchanges. Well, they're not quite 3 exchanges, but three technologies. But if you take the withholding tax, I mean, this is a very interesting discussion. In the withholding tax proposal, the faster proposal, which was, we should call everything faster because it goes a bit faster when we call it these names. We decided that anybody above 1.5% of the market, below 1.5% of market share could be excluded from the need to change the withholding tax. And so many member states have excluded themselves. But I don't quite understand the logic in this. Because I don't have a share in the cross-border market, I don't need to do the things that will get me a bigger share in the cross-border market. So you're right. Most of the action in terms of supply takes place across 3 or 4 big exchanges. But the market is for 27. So it's true that the consolidation may be all around the bigger member states, but the market is for everybody. And that's where this access has to be understood from both sides. So the member states need to understand it's about accessing this bigger, but those with the infrastructure need to understand it's about giving access to everybody, because otherwise it's not going to work. I answered this low-cost, simple product. I'm not talking about inventing new products. I'm talking about making those that are available to the retail investor. And more knowing about it. The United States is interesting because it has both. It has an advised sector and it has a less advised sector. because you need advised sectors. If you want to invest 500,000, I want someone to advise me. If I'm investing, 1,000 every 6 months, maybe I don't need so much advice. I just need a reliable product that I can look every week and see if it's going up or going down and make my decisions. And then I have one last acute, non-acute crisis. This is the boiling frog question, isn't it, really? Because this is always, people who know me know I dislike this story about you need crisis in Europe to make movements forward. I think this is a really inefficient way to make progress. And there are lots of examples where we have made progress. Banking union is one, where we have the architecture of banking union, but we lost the integrated market. So the crisis gave us the architecture, but took away the market for which the architecture was built. And we're still now trying to build the market under the architecture. So I'm not sure this is an efficient way to go. But I think the other question is, are we not in a crisis already now? We just don't feel it like an acute crisis. But if you look, and Draghi, I think, is very eloquent on this, the trend is not very attractive. And it's been going on for a while. And if you extrapolate it forward, it doesn't get better. So this is the sort of, the slow burning crisis that you need to respond to. But as you said, Donald, it's more difficult to get political reaction to that because it's felt less acute. And there's a feeling, I think, as Draghi said, that there's still time. There is still time, but you have to make change in that time that you have left. And if you keep delaying those changes, then you're going to have a problem. And on the product, yes, I mean, we can think about ways in which we can make it easier for retail investors. But I go back to what Eva said. We have to treat retail investors like grown-ups. They can take risks if the risks are explained to them. And I don't ever buy this notion that if you don't advise somebody the way we advise them, they'll immediately go and buy crypto. I mean, it's harder to buy crypto than to buy other products. So I just think we have to have a reasonable debate about this. Build a system where the retail investor can enter in full knowledge of the risks that he takes. That's all. And then he makes his own decisions on the risks that he takes. But
Okay.
I think we can get the balance a bit better than it is now. Thanks.
Very clear, John. Thank you. Brief comment from the others. Jesper?
If I may just add on pension, my hobby horse, one of my hobby horses. In Denmark, we have pension savings of almost 2 times GDP. And the way we can supervise and regulate it, I would consider it to be a fairly safe system for the individual investor. I'm not aware of anybody who's been taken for a ride. So I think it's doable. And I hesitate a little bit when John sits here to say, recommend an area where new regulation may be warranted, but I'll still do it. Because across pension systems, you've had to move from defined benefit / guaranteed rates of return to market-based pension systems which are defined contribution systems. And Solvency II, which is our big regulator, we also have IOP, but we've chosen to use Solvency II for pension and life insurance in Denmark, is very much sort of geared towards defined benefit systems or guaranteed rates of return. We tried to develop something in Denmark in relation to how to regulate these entities which are defined contribution schemes. We don't have that yet in Europe, so that's an area, because I think everything is moving in that direction. Holland is moving that direction. Sweden is moving that direction. I think new systems probably are likely to be somewhere along those lines. So I think we need to set up some sort of standard, and I'd be happy to give John some input, although I hesitate when it comes to add more regulation. But anyway.
Judith, you or Eva?
Just a very short message on risk-taking attitude by EU citizens. And this is the 10th recommendation that we've included in our report to increase financial literacy levels. So, I mean, if we have a look at where financial assets where financial wealth is invested by EU and US citizens, we see that 33% in the case of the US is put into deposits and cash versus 13% in the US. So US citizens, they have a preference to invest in equity funds, which is not the case in the EU. So I tend to think that low levels of financial literacy play a role in all this. And the Eurobarometer of 2023 for the first time already presented a complete picture of financial literacy levels in different member states. So, and also in the levels of trust in financial advisors, which were also very low. So if one does not understand a financial product and one does not trust the advisor in front, I mean, basically for prudence reasons, I would go for deposits or cash. So I think that we have a huge task in front of us to increase financial literacy levels and of EU citizens, and this will probably also lead to a higher risk-taking attitude.
Okay, we're coming towards the end. Eva, you have a final comment or a wish?
A wish. I have a lot of wishes on capital markets. No, but I have no final comment in that sense. I think we ended up agreeing on most of the issues, actually.
Okay, so it's almost 1 o'clock. We had a long debate. I would thank all of you for your interest and for almost having stayed until the end. But as I said, the report is available on our website. You can download it. There's also a short commentary from Apostolos. Apostolos, you can send up. Let's say Apostolos was the person who also did a lot on the report, a lot on the data work of the report. If you have ideas how to take this forward, please contact us. We are there for that. Let's say we're a think tank, and as I said in the beginning, we want to promote the debate, but not only to be driven by certain interests. No, we want to promote an open debate on how to create a more integrated financial market. There are still sandwiches, so if you want to talk with people around, there are still sandwiches across the, in the other place here in the green room, just across outside the door. And then, of course, leaves me to thank the speakers and the rapporteurs. Let's say, first of all, the chair of the task force, Jesper, John Berrigan, for all the comments and for his patience, let's say, having read the report and also having responded to all the comments. And then Judith and Eva and Apostolos, and also my colleague Bea, who was around, let's say, to help us with this meeting, and Alice, to have a successful meeting. So please join me in thanking them.